In today's world, financial traps and pitfalls have become way too common, leading to many people being broke, struggling to make ends meet. These traps come in various forms, anywhere from scams to well-disguised sales pitches. We're all exposed to a barrage of constant marketing messages on a daily basis, and it can be difficult to figure out what's legit and what's out to take your money. As they say, the devil is in the details. Here are 10 of the biggest money traps to avoid. Number 1. No money down plans. While the no money down plan seems tempting due to the lack of an upfront payment, it often has hidden costs. These costs could include higher interest rates, fees, or additional charges over the course of the plan. Without an initial payment, the entire purchase price is usually financed. This means you'll end up paying more over time due to interest accumulation, likely costing you far more than if you had made a down payment. These plans often come with extended loan terms. While this may reduce monthly payments, it also means you'll be in debt for a longer period, paying even more in interest over time. Purchasing items such as cars or electronics whose value typically depreciates over time means you might find yourself owing more than the item is worth, especially if you need to sell it before the loan is paid off. Being late to pay off the purchase within the period of financing usually leads to higher interest rates or fees being added on top, costing you more in the end. Number 2. Buy now, pay later. This is one of the most popular money traps on the rise. The convenience of buying without immediate payment can often lead to impulse purchases. It creates the temptation to buy items you don't necessarily need or can't afford, increasing your overall spending. While the initial purchase may not require payment upfront, buy now, pay later plans often involve accruing debt. A failure to budget and manage these payments can result in accumulating debt over time, leading to financial strain. Many of these plans come with high interest rates or hidden fees. If you fail to pay off your balance within the promotional period, you are likely to incur substantial late fees as high as 25% of the purchase price, costing you way more than just paying with cash. Missing payments or making late payments can result in additional fees or penalties. These charges can quickly add up, making it even more challenging to repay the debt. The best way to avoid this money trap is to only buy what you can afford. Number 3. Car leases. When you lease a car, you're essentially paying for the depreciation of the vehicle during the lease term. New cars lose a significant portion of their value in the first few years, which means you're paying for the most expensive period of the car's depreciation. Unlike buying a car, leasing doesn't give you any ownership in the vehicle. Once the lease term ends, you have no equity to show for the money you've spent. Once you return the car to the leasing company, you start all over again with a new lease or purchase. Leases often come with mileage restrictions, and exceeding these limits can result in hefty fees at the end of the lease term. This can become a headache if you have a long commute or enjoy taking road trips, as it limits your freedom to use the car as you please. Leasing companies typically expect the car to be returned in good condition, and they may charge you for any excess wear and tear beyond what they consider normal. This can include everything from scratches and dents to interior stains, and the charges can add up quickly. Number 4. Playing the lottery. The odds of winning the lottery are almost zero for most people, especially as the numbers get bigger. You have better odds of being struck by lightning than striking it rich playing the lottery. Even though the odds are low, the prospect of winning a massive jackpot creates an illusion of hope. This often leads people to spend more money on tickets than they can afford in pursuit of that elusive jackpot. Many people have a poor understanding of probability, leading them to overestimate their chances of winning. They may believe that because they haven't won yet, they're due for a win, when in reality, each draw is independent of previous ones, and the odds remain the same each time. Money spent on lottery tickets could be better used for daily expenses, savings, or investments that offer more realistic benefits. By using funds for the lottery, you're likely sacrificing your long-term financial goals for the slim chance of a big payout. Number 5. Adjustable rate mortgages. Adjustable rate mortgages, or ARMs, often start with an initial period of low interest rates, making them attractive to borrowers looking for lower initial monthly payments. However, These rates are typically introductory and subject to change after the initial period, usually ranging from 1 to 10 years. After the initial period, the interest rate on an ARM can adjust periodically based on market conditions. This means that if interest rates rise, so will your mortgage rate and monthly payment. These increases can catch borrowers off guard and lead to significant payment shock. When interest rates reset, borrowers may experience a sharp increase in their monthly mortgage payments. This sudden jump, known as payment shock, can strain household finances, resulting in missed payments, late fees, and even foreclosure in severe cases, jeopardizing homeownership and financial stability. Knowing when it's to your advantage to use these loans is key to accessing their benefits while keeping in mind the risks. Number 6. Payday loans. Payday loans often come with sky-high interest rates, typically much higher than those of traditional loans or credit cards. These rates can range anywhere from 300% to 500% APR, or even higher in some cases. Borrowers may not realize the true cost of borrowing due to the short-term nature of these loans. Payday loans have very short repayment terms, usually ranging from 1 to 4 weeks. This means borrowers must repay the entire loan amount, plus interest and fees by their next payday. The short time frame can make it difficult to come up with the funds to repay the loan in full, leading to rollovers or extensions. A borrower is then tempted to roll over the loan or extend the repayment period by paying additional fees, providing only temporary relief. Payday loans can trap borrowers in a cycle of debt, where they continuously borrow to cover ongoing expenses, leading to financial instability and stress. Payday lenders routinely require borrowers to provide access to their bank accounts or post-dated checks as collateral. This allows lenders to automatically withdraw payments from borrowers' accounts on the due date. If borrowers do not have sufficient funds in their accounts, they may incur overdraft fees or other penalties, further exacerbating their financial difficulties. Number 7. Timeshares. Purchasing a timeshare involves a significant upfront payment, often thousands of dollars, to buy into the property. This initial investment can be substantial and may require financing, adding to the overall cost through interest charges. Timeshare owners are responsible for paying annual maintenance fees and other expenses associated with the property. These fees can increase over time and may not be fixed, leading to financial strain. Timeshares often come with restrictions on usage known as blackout dates, during which owners can use the property. This limited flexibility can make it challenging for owners to schedule vacations according to their preferences, leading to dissatisfaction and underutilization of the timeshare. They can also be difficult to sell, especially in a saturated market or during economic downturns. Owners may find it challenging to find buyers willing to purchase their share at a reasonable price, resulting in financial losses if they need to sell quickly or are unable to find a buyer at all. Timeshares typically do not appreciate in value over time. In fact, many timeshares depreciate rapidly after purchase, making them a poor long-term investment. Number 8. Extended warranties. Extended warranties can be costly, often adding a significant amount to the purchase price of a product, sometimes as much as 10% to 20% of the cost. For big-ticket items like electronics or appliances, this can lead to a large increase in price. Extended warranties may not provide comprehensive coverage for all potential issues or damages. Many warranties have exclusions and limitations outlined in the fine print, leaving consumers with gaps in coverage for common problems or wear and tear. Most products also come with a manufacturer's warranty that covers defects or malfunctions for a certain period, typically 1 to 3 years. Purchasing an extended warranty may duplicate coverage that you already received with the manufacturer's warranty, making it unnecessary and a waste of money. Some extended warranties have complex claims processes or strict requirements that make it difficult for consumers to receive repairs or replacements. Number 9. Student loans. Many students graduate with significant amounts of student loan debt, which can be overwhelming and difficult to repay, especially if they have a low starting salary or unstable employment prospects. Student loans accrue interest over time, increasing the total amount owed. For federal loans, interest may start accruing as soon as the loan is disbursed, even while the student is still in school, leading to a substantial increase in the loan balance by the time repayment begins. Many student loans come with long repayment terms, often extending for 10 years or more. While longer repayment terms can lower monthly payments, they also result in more interest paid over the life of the loan, increasing the total cost of borrowing. Failing to make student loan payments on time can negatively impact credit scores, making it more difficult to qualify for loans, credit cards, or mortgages in the future. This can limit financial opportunities and increase borrowing costs. Unlike other forms of debt, such as credit card debt or medical bills, student loans are generally not dischargeable in bankruptcy, except in rare cases. This means that borrowers are often stuck with their student loan debt, even if they experience financial hardship or other life-altering challenges. Number 10. Not paying credit cards on time. Credit card companies usually charge late payment fees when cardholders fail to make their minimum payment by the due date. These fees can range anywhere from $25 to $40 or more, depending on the company and outstanding balance. In addition to late payment fees, these companies also impose interest charges on unpaid balances, with interest charges accruing daily. Failing to pay credit cards on time can have a negative impact on credit scores. Payment history accounts for approximately 35% of the FICO credit score. Late payments can stay on credit reports for up to 7 years and can lower credit scores. In addition to late fees and interest charges, credit card issuers may raise interest rates on delinquent accounts. This then inflates the cost of carrying a balance on the credit card, making it even more challenging to pay off the debt. Higher interest rates can also increase minimum monthly payments, putting additional strain on cardholders' budgets. Understanding and avoiding these 10 money traps is important for protecting your finances and building a more solid financial future. With knowledge, careful planning, and diligence, you can avoid these traps and move towards financial security. Thank you for watching. Let me know in the comments which one of these money traps you plan to avoid. Like the video, subscribe, and share with your friends and family.